Hi, I'm Whitney Espich, the CEO of the MIT Alumni Association, and I hope you enjoy this digital production created for alumni and friends like you.
Good morning, those of you in America and anybody else. This is Sarah Simon. I'm the coordinator of the MIT Alumni Energy, Environment, and Sustainability Network. We are a group of MIT alums who are here to inform, connect alums, and to help get action taken on these three very important topics. Many of us talk about it as a climate issues these days, which is great. We connect people either to help put on these webinars, which we have now done 12. We had a full year of webinars last year. We're delighted you were able to come and join us today again. We also are, as a network, we are trying very hard to set up groups of alumni for synergies. There is a group for MIT Alumni for Climate Action. There is a group of ambassadors that represent different clubs and groups of alums around the world, but we are also open to researchers getting together about environment or water systems or whatever, and we will do whatever we can to facilitate that because we really have a lot to contribute, I believe, to these very important topics today. I just quick wanted to share my screen and show you that our website does have a lot of information. We always have the next coming webinars up on the front page. We have ways that you can, on our participate page, there are ways that you can volunteer, and they don't always work where this thing is under construction, but you can help out with our webinar team, and soon I will introduce you to the webinar team leader. We also have been trying very hard to vet and put out a series of resources about environment, energy, and sustainability. So there are MIT resources, which many of you are looking for, but MIT, of course, is doing stuff all over the institute, but it's here, some of the connections to the departments and centers that it has. And for example, there's now a new Grand Climate Grand Challenge. So that's here on our website. And the website is just here, and I'll put that in the chat for everybody to see. With that, I will turn it over to Ramon Bueno, who's our lead of our webinar committee, and he'll introduce what's happening today.
Welcome to everyone, our guests, and to our audience, especially. We've been, as Sarah said, we've been doing webinars over the past year, and I think people have shown interest in them, and we hope you enjoy this one as well. And look forward to your feedback on. We'll talk more at the end. Suggestions for how to get better ones, and not better ones. They're all good, but to get more of them. I'm going to quickly introduce our speakers and then let them speak. So first we'll hear from Jill Feblowitz, class of 76, who is a longtime consultant and analyst in the energy industry with a focus on innovation. Jill recently served on the Clean Tech Committee of the MIT Enterprise Forum, which brought together the local clean tech ecosystem to support early stage startups. She currently serves on the advisory board for Distributech International's Initiate, it's all caps, exclamation, the forum for startups and utility industry innovators. As president of Feblowitz Energy Consulting, a women's business enterprise in Massachusetts, Jill's focus is on climate risk, energy, and transportation. She holds a SB from MIT in urban studies and an electrician's license from the Commonwealth of Massachusetts. So we'll welcome Jill. Before she speaks, I'm also going to introduce David Miller from the classes of 90, 91, and 07, co-founder and managing director of Clean Energy Ventures. He's a sought-after investor and advisor for companies at the intersection of technology and climate. We'll be hearing on that. David brings over 25 years of technology startup management experience and over 20 years of seed stage investing experience to Clean Energy Ventures. He was director of New Ventures Group at Lucent Technologies and a founder and CEO of Quantum Telecom Solutions. He has served on the board of directors or advisory boards of several clean energy companies, including Boston Materials, Pika Energy, Pearl Certification, and My Energy, as well as mentoring others. An advisory board member of the MIT Sloan Sustainability Initiative. He is a research affiliate at Sloan, and he also has taught electrical engineering at Rutgers University and is currently chapter director of E2, the Environmental Entrepreneurs New England. Welcome, David, as well. So,
I neglected to talk a little bit about the logistics of this webinar. We have disabled the chat and we are looking for your questions. We will have the two speakers, and then at the end we'll have a question and answer. And after the webinar, we will post the slides and the questions and answers when we have worked them through with the speakers, the panelists, and then we will have a video link in 2 to 4 weeks that people will be able to see the recordings. Raymond, back to you.
No, without any further ado, Jill, please welcome.
It's nice to be here. It's a good day, everyone. I'm really excited about talking to you today, and I'm excited for more than just being here. I'm excited because the US has recently rejoined the Paris Climate Accords, which is really great. And there's a lot to talk about today. There's a lot of very encouraging news on the clean energy funding front. And despite, and perhaps because of COVID-19, clean energy spending is up globally, and that's good news because there needs to be a massive global effort to get the world to 1.5 degrees centigrade global warming above pre-industrial levels. So I'm here today to talk about the prospects for sustaining an upward trajectory in government funding and private investment. So we'll start with the trends. The good news, as I mentioned before, is that globally clean energy spending is up. According to a report released by Bloomberg Energy New Energy Finance last week, the world spent a record $501 billion in 2020 on renewable power, electric vehicles, and other technologies to cut dependence on fossil fuels. Europe's spending was up a whopping 52% compared to 2019, substantially better than the US, which was down by 20%, or China down by 12%. Europe was especially strong last year in transportation. And China, of course, has a head start there, so didn't spend as much. But China installed 60% of the world's wind, much of it offshore. And I want to talk a little bit about the buzz, something that you really can't capture with figures. As for the buzz, EU is about renewable hydrogen. Note the EU's climate strategy to move renewable hydrogen to scale by 2030. It's pretty ambitious. China is always also on a hydrogen tack, ramping up investment in fuel cells for transportation, primarily through coal gasification as a source of hydrogen production. In the US, energy storage is seeing an uptick in interest and in investments, and electrification is also a really hot topic. So today I'll be looking at government and private funding. In private funding, I mean venture capital and mainstream investment. And I want to apologize in advance for focusing mostly on the US. There is much to be said about the efforts of Europe and China. For example, 37% of EU's 700 billion euro recovery package goes to clean energy. And for China, it's that country's commitment last fall to becoming carbon neutral by 2020. However, there isn't enough time to adequately cover what's happening in those regions. Right now, though, I would like to give you kind of a global view of what's happening to drive investments. There's an increased emphasis on accountability and awareness of climate risks. For many companies, that means the transition to a decarbonized economy and physical risks related to climate change. Investors like BlackRock are pushing on climate risks. Why should they invest in a company with assets that could literally and figuratively be underwater in a few years? You may have heard of the Task Force on Climate-Related Financial Disclosure, or TCFD. The TCFD provides a framework for companies to disclose climate-related risks as part of their regular financial reporting and to show how they are going to mitigate those risks. Both the UK and New Zealand have made TCFD financial reporting mandatory. And recently, the Commodities Futures Trading Commission, the CFTC, released a report pointing out that climate change poses systemic risks to our financial systems. The report also advocates, and this is interesting, coming from the CFTC, a price on carbon, as well as a climate risk disclosure for multiple time horizons. At the same time, attitudes on the need for decarbonization have changed. For example, a just released study by Yale and George Mason University found that 66% of US voters said that developing sources of clean energy should be a high or a very high priority. That's quite a shift. The clear skies during COVID, rising temperatures, and the increase in extreme weather and wildfires are likely to be a part of that change in attitude. Government legislation and regulations also drive investment by providing incentives. Some even set legally binding net zero targets this year. Finally, clean tech is now seen as a less risky space, a space where new companies are delivering solid returns. Assuming that prospects are encouraging, how do we ensure that the dollars that are being spent go to clean energy, that going to clean energy are going there in the right places? Well, the UN's Intergovernmental Panel on Climate Change has developed a set of pathways for emission reductions. But if you want to play around with alternative pathways, En-ROADS is an easy to use, transparent open source tool developed by Climate Interactive with the MIT Sloan Sustainability Initiative. It's especially good for introducing teams to high-level impacts of climate change. You can see on the screen here that moving the lever for subsidizing renewables lowers greenhouse gas emissions. You may have heard from some people that we have all the technologies we need to reach IPCC goals. We just need commitment and the funding to deploy them. On the other hand, there are some that say there may be technologies or approaches that could make significant impact on emissions, but they haven't been developed or even conceived of yet. It's my opinion that we need to get as much mature, clean technology deployed in the next 5 years while still funding R&D and startups to deliver in subsequent years and starting that funding now. Let's look at how a twinkle in the eye evolves into a concept and then to commercialization. You may be familiar with the path from an idea to commercialization. To get there, budding companies go through a technology valley of death, proving the concept, and a commercial valley of death, getting to scale. They go from concept, prototype, or proof of concept, pilot or demonstration, commercialization to maturity. It's not a straight line, as many founders may attest. All of these stages need support, including funds. Government funding is essential for R&D and demonstration, and now there's a prospect for more help with commercialization. If you look at Section 9000 in the Energy Act of 2020, private investment, think corporations, plays a role too in R&D. Angel investors and venture capital support startups at early and later stages of the company development, and mature companies, both private and public, and even large-scale projects need investment as well. Think shareholders, debt financing for utility-scale solar. Now let's look a bit more closely at government funding and private investment. So here again, I'm concentrating on what's happening in the US now. Federal is where the big money will be, especially as states are constrained by the economic impact of COVID. That's not to say that states don't play a big role through policy regulations. States can encourage adoption of energy technology like rebates for personal EVs or trading market funds. For example, the Regional Greenhouse Gas Initiative provides a market for states to sell CO2 allowances and then invest the proceeds in energy efficiency and renewable energy. But the federal government is where the large impact will be going forward. Even without legislation, there's a lot the federal government can do with clean energy procurement. According to GTM, there are plans to spend $400 billion on federal procurement of renewables, batteries, and electric vehicles. And President Biden has just announced, I think it was yesterday or today, plans for the entire US federal fleet, over 645,000 vehicles, to be replaced with electric vehicles made in the US. Going forward, also, you should expect to see more spending on energy efficiency in federal buildings, IT for managing federal facilities' energy usage, and even smart federal buildings. The Energy Act of 2020 that was passed as part of the latest budget and the Economic Recovery Plan provides funding of $30.5 billion for programs, R&D, demonstration projects, and commercial applications. Digging a little deeper into the dollars, not including funding to maintain existing federal offices, here's how funding breaks out. Not all the funding is considered innovation in the sense of technologies. For example, administrative costs and modernization of existing nuclear plants makes up about 10% of the $6 billion in nuclear modernization and advanced reactors. The energy efficiency category contains a sizable amount for traditional weatherization programs, important, but not from an innovation lens. There is a heavy commitment to carbon capture, utilization, and storage. Over half of that money will go to large-scale projects and also pilots and demonstration projects. And the Rhodium Group expects that CCS will yield meaningful cumulative industrial emission reductions of between 342 and 585 million tons between now and 2035. ARPA-E, the energy version of DARPA established under the Nixon administration, will see an increase in funding. The agency is focused on concept development, prototyping, and proof of concept. The budget will increase 75% to $760 million by 2025. Transportation energy R&D is broadly defined as sustainable. The category calls out fuel cells, but not specifically electric vehicles. Electric vehicle infrastructure is hardly even mentioned. Less than $300 million is devoted to grid integration of both renewable energy resources and EVs. I wanted to mention as well that it's notable that carbon removal and hard to decarbonize sectors, think industrial sector, have made their way into the Act. Expect to hear more about these approaches in the future. Now, some have called the Energy Act a down payment on what is needed for decarbonization. There's every indication that the current administration will be pushing clean energy. Going forward, though, increased funding will depend on bipartisan support. Now, let's move on to private investment. Private investment in clean energy is doing better than you might expect. Mainstream investment, public trading, public market and debt financing by corporations, institutional investors, retail investors are an absolute necessity if we want to reach decarbonization goals. According to Bloomberg, there's been a jump in the share price of publicly traded renewable companies. That's good news. The NEX, an index of companies active in renewable and low carbon energy, was up more than 140% last year, easily besting the Standard & Poor's 500 and NASDAQ. Recent data from Mercom, and you see that on your screen right now, looks at solar, smart grid, batteries, and energy efficiency. The chart shows public trading / debt financing along with VC investment. you can see an outsized infusion of capital in solar in 2020, in large part due to the falling price of solar panels. Then two solar projects receive a boost in anticipation that the federal investment tax credits would be ending. Note an uptick in battery storage by VCs in 2020 as well. High-tech corporations are also jumping in big time. Amazon's $2 billion climate pledge, created in June, aims to invest in companies in multiple industries covering all sizes and stages, from pre-product startups to well-established enterprises to scale. To date, most of the investment has gone into startups. Now, I really love the statement of Abe Yokel, who is the managing partner and co-founder of Congruent Ventures. He gives us a reason why he thinks high-tech companies are jumping in like this. He says they're jumping in because it's an in-crowd activity. They're really interested in skating to where the puck is going. What should they be doing to decarbonize their entire effort? What's going to be the price of carbon? What's happening going forward? They want to seek returns, but they also want to be supporting their employees and climate goals, and they want to make sure they are mitigating future risks, both climate and regulatory. But it's not just mission-driven that investors are looking at. Investors are seeing real returns from investment, especially in valuations of startups. We've seen a lot of that in the transportation space. There are relatively new mechanisms, such as investment platforms and SPACs, that could encourage greater investment in clean energy. SPACs are shell companies listed on exchanges with the mission to buy private companies and then convert them to public ones. Warning, I am not an expert in these areas. SPACs are alive in clean energy and EVs, and there were 4 large deals in 2020. However, the jury is still out on whether these will be sustainable investment paths going forward, and for companies who want to go public. Investment platforms could provide ways for citizens or retail investors to contribute to clean energy. Like platforms like Robinhood, which list renewable energy stocks, are an example there. Still, there's a lot more consumer education and promotion needed to get these platforms popular. There are also more traditional mechanisms. Green bonds grew by 13% to a record $305 billion after a slowdown in the first half of the year. In some regions, green bonds have gone beyond investments in renewable projects and are now available to cover investments in the energy transition. JP Morgan and Chase is forecasting a 30% growth in global green, social, and sustainability-linked issuance this year. The ESG space is a whole nother topic we can leave to another time. Government policy can go a long way to encouraging private investment and procurement of clean energy. And there's a recent example of the EU, who's established a financing platforms where investors can seek out potential projects and member states facilitate development. So where does that leave us? Immediate prospects for clean energy funding will depend largely on clean energy and whether it can be tied to the economic recovery. Decarbonization too is like real estate, location, location, location. There's lots of simulations out there that get more granular than what we saw earlier. The good news, according to some experts, is that the Energy Act is funding open source tools for state, regional, local, and utility planning and operations. We will need to get to more granular modeling to determine what the most cost-effective approaches are going to be, and approaches that meet the goals of climate change mitigation and also economic recovery, job creation, and meeting the needs of vulnerable populations. I thank you for your time. And next up, we'll have David Miller of CEV to talk about the state of early stage startup funding, ways that investors can assess GHG potential, and a couple of case studies. I'm going to turn it over now to David.
All right, fantastic. That was great. All right, well, let me share the screen and make sure that this works. All right. Is this coming through? Can you see the PowerPoint? Someone give me a thumbs up. All right, fantastic. All right, well, thank you, Jill. That was really helpful. And I'm gonna build on some of the points, and I see some good questions coming in as well. So looking forward to the Q&A. So I'm gonna try and get through my presentation relatively quickly. I'll try and talk fast because I wanna leave time for the good questions we have already and some more Q&A after that. So just a little bit about me. I'm proud to call myself an MIT lifer. I got my bachelor's and master's in 90 and 91 in course 6-3, and then came back and did the technology and policy program 2002 to 2004, and then transitioned to technology management and policy in the ESD PhD program through 2007. And then I've maintained my affiliation as a research affiliate as Sloan through present day, and I'm also on the advisory board and strong supporter of the Sloan Sustainability Initiative. And through that, actually, I've been quite involved in En-ROADS, which Jill mentioned, which is a fantastic tool for understanding the policy options around climate action. So highly recommend folks take a look at En-ROADS. And in the interim, between my MIT stints, I started and ran a telecom software company in the late 90s. And then when I came back to MIT, I co-founded Clean Energy Venture Group, a group focused on investing in early stage climate solutions from a private investment or angel perspective. And that group has grown over time to now 35 partners. And then over the last several years, myself and Dan Goldman and Temple Fennell, pictured on the slide, started Clean Energy Ventures, which is a $110 million venture fund dedicated to solving the climate crisis through investing in these early stage companies. And hence, this is our mission, to invest in highly disruptive advanced energy companies that have the potential to significantly mitigate emissions, as well as generate top decile venture grade returns. And I see those as not just an and, but I see those as causal. I see the mission to reduce emissions. The companies that will be most effective in reducing emissions at scale will be the companies that will be most profitable, because that is what the world is driving towards, as we just heard Jill talking about. So it's not an either or even an and, but it's a causal factor. The companies that are most effective at reducing emissions will be the most profitable. And just look at the economic opportunity, and once again, Jill talked about this, related to addressing climate change. A mere 5 or 6 years ago, when we were preparing slide decks in 2015, we talked about a $3 trillion opportunity looking at sources at that time. That $3 trillion opportunity has now turned into a $50 trillion opportunity that's going to need to be invested and most likely will be invested to address climate change. And we're talking about the creation of really the largest global industry will be clean energy, certainly within that time frame. And we have 120 national governments, and very happy to say that now includes the United States, if we include the pledges of President Biden. And very, very happy to hear that and see that. And, 1,541 companies, and that number is growing rapidly at an accelerating rate, again, as Jill referenced. So we certainly see a lot of momentum, and you see the momentum here as well. The VC investment, we've been doing this since 2005. And even, again, 5 years ago, it seemed like a big number at the time, but it's risen dramatically since then and continues to rise dramatically. The investment just in the VC industry in climate tech. However, there is a gap. And that gap is a gap between the early stage funding, the R&D funding that the government and industry traditionally covers, and we certainly expect to see significantly more funding from government and industry for early stage R&D, so that's fantastic. And then on the other side, on the growth side, you know, you look at that chart, a lot of those dollars are going on into growth capital. So the companies that have some momentum, that are in the market, that are generating and accelerating their revenue, those companies are seeing more and more growth capital being sent to them. However, there remains a gap in between those two areas, which is the early stage of commercialization. When the R&D is done, the product is ready, it's ready to enter the market, but it's not yet proven in the market. It's not yet at the growth stage. So it's not quite ready for the growth capital. It's graduated from the R&D capital. And that's where we look to come in. And it's not just us. I mean, there are certainly other early stage funders as well, but there aren't enough. Not enough to meet the opportunity, not enough to meet the challenge that the world is seeing to have these technologies that have the potential to mitigate climate change be commercialized at scale. But it's certainly our focus to address that gap. And there's another important gap, and this is the emissions gap. So what we see here, the entire length of this chart, is the amount emissions need to be reduced in order to have a good chance of the global temperature rising no more than 1.5 C, which, as best as we know, is a safe level. And we're not there yet. We're actually not even as close as we need to. If all the nations in the world meet their Paris Agreement pledges, that's the green area, that's not even half the emission cuts that are needed. We need the blue area as well. So if you add up our 2.5 gigaton metric per company across the size of our expected portfolio, if all of our companies met that metric, it would be the dark blue on both of these graphs. So certainly doesn't meet the entire challenge, but it's visible on the graph, which is our goal, right? If we do this, if other funds do this, if additional funds go to supporting and commercializing early stage clean energy technologies, we can address this gap. This is doable, and current pledges are going to have to increase as well. But this is the point behind our 2.5 gigaton per company metric, because if that metric was significantly smaller, you wouldn't even see it on the graph. And if it were significantly higher, then it's not really realistic for an early stage company to presume that they're going to meet it. So this is what we try and do. But next comes the question of how do we do it, right? So we're looking at companies that mostly aren't firmly established in the market yet. So we can't look at historical records. We can't see the emissions that they've already done. So we have to assess what they might do, what they could do. And this is over a 30-year period. This is by 2050. So what we've established is we've established a way to screen companies that come to us. We have literally hundreds of companies that applied for funding to us. And that's wonderful. It's incredibly emboldening and creates a lot of optimism to see so many companies trying to address this issue. But of course, we can only fund a few of them. So we have to have a way of quickly assessing what the potential of companies meeting that 2.5 gigaton metric could be. And so we've established program that we call SERC, Simple Emission Reduction Calculator. That's a simple test upfront at the assessment phase. And this is important to distinguish it from other tools, powerful tools like Crane, which are often used during the diligence phase, which are much more extensive. But the point of SERC is to be simple, quick, at the assessment phase, look to see what the potential of a company is as we begin to spend time assessing the company. So we really ask essentially two questions. One is, for whatever it is you are producing or selling or doing, what's the impact of that, right? What is the impact for each unit that you sell or deploy? How much is that going to reduce emissions? And then, how many units are there going to be? It's really that simple. We assume that there's going to be an S-shaped growth curve of whatever the technology, product, or service is, that we're starting here on the left side with very little deployment. There's going to be some exponential growth, and then it's going to tail off. Classic S-curve. So the questions we ask are here. It's probably too small to read, but it's essentially what I just said. We're asking, what is the impact? And we give the entrepreneur the choice to answer the question in either kilowatt hours, if they're reducing electricity usage or producing electricity, or directly in tons of CO2 reduction, if it's a direct reduction in CO2 emissions. We then ask them how many years it's going to take for that to happen, so we can calculate the S-curve, how many units will be sold at the top of the S-curve, and how many years that's going to be between now and then. And also how many years each unit will continue to have impact once it's deployed. So to give you an example, this is a company that we looked at, and at first glance, it might not seem as your traditional clean energy company, because what they do is they make spacers used in reverse osmosis water filtration systems. And those spacers extend the life, lower the cost of reverse osmosis filtration. So fantastic thing to do, very attractive in the market. But how is this reducing greenhouse gas emissions? Well, first of all, it's significantly reducing the amount of energy used in those systems, and those systems are used quite extensively. So when we fill out the SERC form, we ask how many kilowatt hours of grid generated electricity are going to be reduced per year at the maximum scaling factor. And we get that answer. We also ask, well, are there any other ways CO2 is going to be reduced? And that's actually begins to be significant by reducing trucking. So that gets added in. We then look at the scale of the units sold, the number of years before that's going to happen, the cumulative effect of these systems, because once a system is in the field, it's going to be in the field for 4 years, so it continues to have that impact. And when you do the math, fill out the S-curve, it actually adds up to 2.5 gigaton. Turns out that reverse osmosis systems use a significant amount of energy. And so something that saves a significant amount of that energy and is deployed at scale will have a very large impact. So just an example of a company where at first glance, is this really going to have an impact? Well, yes, it can. And then when we do our diligence, we verify each of those numbers. Of course, we don't know for sure, we don't know the future, but we look at the market, we interview customers, we do a lot of physics-based analysis to make sure that it's feasible, market-based analysis to make sure that the market will support this scale of deployment, and we reach an assessment of whether and how likely this can be. So we invest across a wide range of solutions within clean energy. So that was an example of the water energy nexus, which is clearly important. But there are other clean energy nexi that are important as well. Energy storage, and we are very, very close to investing in a energy storage, a battery technology, a platform technology that will improve the performance of a very wide range of lithium-ion type batteries. It's not a single chemistry. It'll support a very wide range of chemistries and actually significantly increase energy density, power density, lifetime, cycle life. So we're very excited about that. Obviously, storage is an important part of the clean energy solution. Innovative finance is an area where we've looked at a significant amount of companies, haven't made an investment yet, but again, that can make a large difference in deployment of clean energy. Recycling, we actually have made a recent investment, which is not quite yet public. Clean mobility, of course, is critical, whether it be vehicles, air transportation, or other. And the company we invested in that space is actually enabling zero carbon liquid fuels that will work in diesel engines. So obviously EVs are important, and our battery investments will support EVs, but having zero carbon liquid fuels will be a very important part of the solution in the future. Advanced materials, so that applies, of course, to transportation as you lightweight vehicles. And again, a critical part of the clean energy future, because, for example, in air transportation, you can't get to entirely an EV-based system, so you want to have energy efficiency and lightweighting in the systems. Energy management cuts across a broad range of solutions that enable deployment and transmission of clean energy. Clean energy production, of course, is typically what folks think of, producing solar energy, producing wind energy, and other forms of direct energy production. Energy efficiency, of course, reducing energy usage is critical. It's really a low-hanging fruit. We've evaluated, again, hundreds of companies that have energy efficiency type solutions and have invested in a few that we think have very, very unique and transformative type solutions. So I wanted to give a case study, a couple of case studies, because I think it really drives home to talk about, I can talk in general terms about different types of solutions that have transformative effects. So I wanted to give a couple of case studies on companies that directly do that. So this company, SunDensity, started by a fellow MIT alum, PhD in '92, is on the energy production side. And this is a coating that increases solar power output by over 20%. So you could take a 22% efficient cell and make that 27% efficient. Very, very significant increment. Imagine the amount of solar energy being deployed and increase the energy output by 20%. It's doing that by shifting the wavelength from blue to red. It enables greater energy output. And this is a technology that's quite nascent at the moment, but again, can have significant impact. Last case study is a company that is not necessarily a high technology company. I mentioned energy efficiency, the importance of energy efficiency before. And this is a company that enables energy efficiency by making it more visible and marketing the importance in the residential sector. So highlighting an energy efficient home is more valuable. It sells quicker, it sells for more money. Therefore, homeowners have significant incentive to install and deploy energy efficient solutions in their home. And therefore, those energy efficient solutions are sold at a much higher rate. And energy efficiency is realized in the residential sector at a much larger scale over time. And this is a company that has already proven the ability to scale, being deployed in 40 states across 87,000 homes to date. So not necessarily a technology per se, but a way to enable deployment of efficiency at scale. So one other thing I wanted to mention quickly, as we're talking about the new era, is that not just the technologies we invest in are important, but the teams we invest in are important. And the whole idea of diversity, equity, inclusion is not just a slogan. It's not just a fad. It's something that enables companies to perform at a higher level. And so it's just something I just wanted to point out, that part of how we want to enable a better climate future is enabling in very effective companies, and companies are more effective when they're more diverse. And that is a proven, has been proven by showing that companies that are more ethnically diverse perform better and more profitable. So with that, I wanted to get to Q&A and looking forward to responding to questions.
That's great. That is great. There was one very specific question for you about percentiles and what you meant by, maybe it was also for Jill. Please define, clarify top decile investor returns.
Oh, sure. Well, I mean, that's basically if you take all venture capital fund returns across the industry, and you graph them or map them, our intention is to be in the top 10% of those returns, basically perform better than 90% of other venture funds.
Okay.
And in the investments that we have made to date and in earlier capital that we've managed for other investors, we have done that. And we intend to continue doing so because, again, climate solutions are, we believe, will be more profitable solutions. There was also a question on carbon pricing.
Yes.
And I'd like to address that because that's actually an area that intersected some of my PhD work. In that, for my PhD at Sloan, I developed a model of clean energy ventures, and I looked at policies that impact their performance. And it turns out that of any government policy, regulatory, tax breaks, improving access to markets, that carbon pricing had an order of magnitude better effect on both rate of success and rate of growth. And so it's become an area that I've paid attention to over the years. And I have followed the British Columbia experience. And one thing that we see in that is public support actually grew as the price increased. Over the initial phases of that program, the carbon price was increasing. And as the carbon price increased, public support increased. And then eventually the price stabilized and public support stabilized. But it was a demonstration that support can improve over time as the price increases. And the other thing that we saw in the early phases of that program is that it had an outsized impact on behavior beyond what economists would expect, given the relatively low price. It actually had a larger impact than expected. So that's also a positive sign. So it is true that the price did not increase as much as one would hope, and was frozen over time. So, and obviously there would be a hope that a program like that would happen on a national or international basis. So this isn't a complete solution or answer, but I think there is evidence from that program that carbon pricing can be effective. And the other thing I'll say is it's not an either or between market-based solutions like carbon pricing and regulations. It's absolutely an and. We cannot, and you can see this in En-ROADS. We're not going to get to 1.5 C with any one policy or even just a few policies. We're going to need every policy. And so that's going to have to include regulatory approaches, and it's going to have to include carbon pricing if we want to have a good shot at getting there.
Thank you. Jeff Berner asks, if the U.S. was to pursue what we would call industrial policy, what would that look like in clean energy? Jill, I think you started talking a little bit about that. Industrial policy being government measures aimed at improving competitiveness and capabilities of domestic firms.
Well, I talked about it in the context of hard to reach industries. But I have to say, I'm not an expert in industrial policy, so I'm not exactly sure how that might work.
One of the things in there in the definition is the infrastructure, transportation, telecommunications, and energy. So that was the question. If we focused on industry sectors, how would that look in clean energy? David, have you got some comments? And maybe Jill will have a couple more after.
Yeah, well, I mean, clearly, and again, this is the all of the above on clean energy approach. So yes, of course, we have to do infrastructure. And it's energy infrastructure, but economy wide, I mean, everything has to become more efficient. So energy efficiency has to happen across all industries. Plus, obviously, we need grid infrastructure, transmission systems, and so forth. We need transportation infrastructure, charging infrastructure for electric vehicles, and so forth. And when we do that, we do become more competitive.
Yeah, I would agree with that. I mean, from a utility perspective too, there's a lot in this for utilities. You know, that's one of the reasons for the pushing electrification, and a lot more utilities are in that particular sector are really moving towards understanding that that's going to be they're going to be involved with new business models in conjunction with private companies to deliver that infrastructure. So I think that will make us a lot more competitive. I think Europe is kind of ahead of us in deployment of the infrastructure for electric vehicles. Smart charging is definitely a part of that, but we could leap ahead in those areas if there were sufficient resources dedicated to that.
You know, one thing I like to just comment in the way of context, just like we've been talking about finance, investment, and Jill, you mentioned the task force on disclosures. That it's interesting that in the last couple of months, there have been a number of initiatives on the financial systems appreciation of risk from climate. Back in, I think it was towards the end of the year, the Commodity Futures Trading Commission had a working group on climate risk, and they put out a pretty substantial report that I encourage people to, it's called Managing Risk in the Financial System. Very thorough look with recommendations across the board, including carbon pricing. And I've also seen that the Federal Reserve itself, in the waning months of the year, of last year, joined an international central banks network precisely that look at the greening of the financial system. And this morning I see E&E News quoting an enormously big deal where the Fed is creating a climate committee to look at precisely, again, how climate risks factor into the decisions that they need to be thinking about and making. So you don't have to comment. I just wanted to add that that's a very timely discussion you guys are bringing to the topic here.
That's great. We have a question here from Tom Alexander about how one factors political risk into all of this.
Well, I'll say quickly. I mean, so as from our investment perspective, we avoid political risk. So when we invest in a company, that company has to stand in the current market as it is. And we can't assume, let's say, a carbon price. So we won't invest in a company that depends upon a carbon price that doesn't yet exist. That said, if the carbon price happens, it most likely will accelerate the positive performance we already expected. So, and then on a broader perspective, you know, I think there's a very, very significant known amount of climate risk that has to be addressed. So from our political leaders have to assume leadership, and they're going to have to take risks in order to accomplish the scale and the intensity of public policy that's going to be required to meet the climate challenge.
Okay. David, you wanted to answer one more question, and then we're going to have to wrap up pretty quickly, although there is a question here. What can recent grads do to get more involved in this space? And again, if there are specific questions for our panelists. They have provided their contact information. But anyway, David, you were going to ask about you were being asked by BizBoz about is there possibly significant overlap between emissions reduction? Please
Yep. Yeah.
spend
So I
2
see.
minutes and then I want to try and wrap it up.
Okay, I'll answer quickly. So 2 questions, one by Keith Alverson and one by BizBoz related. So Keith's question really has to do with the rebound effect in energy efficiency, which is the idea that if you have a lot of energy efficiency, it makes it cheaper to use something that requires energy, then people are going to do more of it, right? And so yes, that does happen. And so it does somewhat mitigate the emission savings you get. But at the end of the day, energy efficiency still has a positive impact in reducing emissions. So yes, there is some rebound effect, but no, that doesn't mean you don't do it. Just means that you do it more, and you still end up with a beneficial impact. And Biz's question is talking about kind of overlap. For example, you know, the world is going to do certain things, whether our companies do them or not. And don't those overlap? And the answer is absolutely yes. And no, our simple model does not take that explicitly into account. And that's partly how we make it simple. The point of the simple model is like, is this going to have a significantly positive impact or not? It's impossible to know all the levels of feedback that will occur over a 30-year period. We just want to know, is this going to be part of the solution, and could this be a significant part of the solution? And if there's overlap, if there are multiple solutions that are doing the same thing, fantastic. Let's solve the problem 10 ways instead of solving it 0 ways.
I wanted to just chime in there about the energy efficiency. I think, you know, there's also a dimension to consider there about when the energy is demanded. And so I think energy efficiency now is being much more closely related to demand response, and that has to be part of the issue as well. And as regulators start to get into more time of use rates and more dynamic rates, I think we'll see the incentives go up for using energy that's produced more cleanly.
Very good point.
That's great. I want to thank you both. We do have a remaining question here, is what can recent grads do to get more involved? And we also have an offer here by the Club of South Texas about coming to their workshop, their En-ROADS workshop. It's in the chat. It's in the questions and answers there. It is also on the EESN website. And so I want to say that the EESN network is open to all alum-focused efforts. And all of these groups, the Climate Action group, MIT Climate Action, Alumni for Climate Action, includes a group who is doing, putting on En-ROADS workshops. And any of you in your clubs or in your other environmental groups that you work with are welcome to ask for a workshop. We would be happy to try and get that set up. And then there just is the question of we do need help with, not help, we would love your suggestions and support on how we're going to set up this series in the next 6 months. How we are going to better connect and cover a nice range of topics that might be of interest to everyone out there, or you in the alumni neighborhood and in the alumni community. So the investment has to happen now for us to get to 2050 as a net zero society. The transportation questions certainly are big, and you should feel free to talk with EESN and the panelists today. And Raymond, do you have a final thing to add, because we are just about at time?
Yeah, I would just say if you in the audience find these, and if you've been in past webinar audiences, you find them useful, spread the word to other friends and acquaintances in your circles that are alums. And actually, this is not restricted to alums, these webinars.
Yes, our webinars are open. All of our education is for everyone, but our groups, we really want to get the alums together. I'm sorry, Raymond, but we're out of time.
No. write to us with suggestions, rbueno@alum.mit.edu or the website at EESN.
Thank you for coming today, folks. It's been a pleasure. I really found it interesting. Thank you. Bye.
Thanks for joining us. And for more information on how to connect with the MIT Alumni Association, please visit our website.